Okay, now we'll get to the important stuff. There's always something to worry about. This is the difference. This is what happens in the stock market. Because, see, everybody's got the brain power to do well in the stock market. The question is whether you have the stomach for it. That's the key organ in the body. There's always something to worry about. I went to school, grew up with a kid in the 50s. In the decade of the 50s, there's this big theory that the Depression was caused by a stock market crash. Totally wrong. Less than 1% of Americans owned stocks in '29. We had this big-time recession. In fact, it was a depression. It wasn't caused by the stock market. The economy went down, the Federal Reserve raised interest rates, and we had a big-time depression. In fact, we had several depressions like that from 1850 on. This was only one of about 8 depressions since 1850. But people thought the only reason we got out of the depression was World War II, and they said, once we get back, next time we have a recession, we're going to have a depression. And it's going to be a great depression. I never understood that adjective in front of depression. It ought to be crummy depression or bad depression, but it was always great depression. I never quite understood that one. So people weren't buying stocks in the 50s because they thought that another Great Depression was going to happen. In addition, people were very scared about nuclear warheads and nuclear war in the 50s. People were building fallout shelters, stocking canned goods. There's something about going to Vermont, building a fallout shelter, putting canned goods in it, that you don't buy Minnesota Mining or you don't buy East Dakota. I mean, the syllogism just doesn't work out that you're buying lots of water, buying a shotgun, buying frozen food that will stay in the freezer with your own generator, and you're looking at growth stocks. Doesn't seem to work out that way, you know. And I remember in the 50s, I mean, I remember literally in classes, I was in elementary school in the 50s, and they'd come in, they'd have one of these air raid drills. Somebody with a yellow hat would come in, they'd blow a whistle, and you'd get under your desk. Even then I said, I don't think this is going to do a lot of good, you know. But people were worried about a depression in nuclear war in the 50s. And then, the warheads, they couldn't do much damage back in the 50s. Now one of these Stan countries, you know these Kakistan and Kazakhstan, all these Stan guys that have spun off these Friedman building spin-offs from the Soviet Union, they didn't lead it. There was a co-deal with somebody else, like Goldman Sachs, and they were on the left side though. Every one of these little countries has enough warheads to blow the world up 88 times. I mean, who's built a fallout shelter there? You know, we stopped worrying about it. I mean, there's always something to worry about. In the 50s, it was depression and nuclear war. The 50s was the best decade of the century for the stock market, except for the 80s. Only slightly better. The 80s were only slightly better. People didn't expect a lot. We had an okay, it wasn't a great decade. They just didn't expect much. We made it through. And the stock market was terrific. Do you remember when oil went from 4 to 40? Remember that period? Oil went from 4 to 40, and the experts said it was going to go to 100, and all the countries of the world were going to go bankrupt. And then the big banks are going to go bankrupt, and we're going to have a Great Depression, and the stock market's going down, and you're going to wind up selling pencils and apples. You know, well, I remember when oil went from 4 to 40, and the experts said it was going to go to 100. Within 2 years, oil was at 14. The experts, now much higher paid at this point, are saying it's going to go to 4, and we're going to have a depression. And people believed it again. You know, I remember when the money supply was growing too fast, and they said we're going to have a depression. Then it was growing too slow. We're going to have a depression. Remember the LDC debt? Remember the LDC debt? All the banks. Our banks are very smart. They lend all their net worth to Zimbabwe and Botswana and Botswana and all these countries. Chile, a lot of countries they can't pronounce. This is Chase Manhattan and Chemical and Manufacturers Hanover. These countries weren't doing so well. Then they were called undeveloped countries or less developed countries. Now you have to call them emerging countries. It's not politically correct to call anybody an undeveloped country. It's like I just found out the other day the term for somebody that's overweight is laterally challenged. You have to say something laterally challenged. But these were LDC debt. They were all going to go bankrupt, and we're going to have a depression. Then the Mideast was going on in the world. Remember that one? The Mideast was going on in the world. They weren't going to buy our bonds, and the market crashed, and we're going to have a depression. Then Japan was going on in the world. Remember that one? Japan was going to have all the assets, and they weren't going to buy our bonds, and we're going to have a depression. Within 3 years, the Nikkei Dow had gone from 40,000 to 16,000. The banking system was in trouble, and people said Japan was going to collapse, and we're going to have a depression. I mean, people had, on their prayer list, at the end of the day, they had eliminated crippled children and Mother Teresa, they're praying for Japan. I mean, you know, it's a country with a 15% savings rate, you know, it's something bizarre, you know. Commercial real estate, global warming, you know. And I think as the older you get, the more nervous you get about these things. I think it's very valuable. I think while younger people are better investors is they're not worried. They haven't heard about all these crises. And they're with children. I think if you don't have any kids, you got to rent some kids for the weekend. You know, Get a 7-year-old and ask him if he knows about the money supply, you know, how fast it's growing. Ask him if he knows about the shape of the yield curve is the wrong shape of the yield curve. Or that we're 48.3 months into the economic recovery and the average recovery lasts 52.3 months. You know, ask an 8-year-old if they know about that. 8-year-olds have a very high expectation about the next 20 years. That's what you need to do. The more you get away from 8-year-olds, the more you get away from 11-year-olds, the more you start reading these crazy things you read over the weekend. In fact, from 1955 to 1985, the stock market went up a grand total of 1,000 points, but it was down 800 on Mondays. So it was therefore up 1,800 on non-Mondays. It wasn't an accident. The stock market went down. October the 19th, 87 was a Monday. People over the weekend become economists and portfolio strategists. You know, I mean, they're a bull if they take their lunch on the way to work. You know, in fact, I knew very well the market was going to go down in October of 1987. Dave Elson remembers that. It was my first vacation I was going to take in 6 years. And we decided to go to Ireland, and we stayed at all these little cottages and play golf. And I left on Thursday after the close of trade. The market was down 55 points, which wasn't a good start, but it was down 55 points. And we got over there, and because of the time zone, we were able to do what we wanted to do and get down to Cork, and called in. The market was down about 118. And I said to Carolyn, if the market goes down on Monday, we better go back. But we're already here, so I'll also stay for the weekend. So as you know, the market went down 508 on Monday, so I flew home. Because my fund had gone, I think, from 13 billion to 9 billion in 2 working days, and it was the trend here is not positive. Like I could do something about it, you know. But there's time when they called, they wanted to say, well, what's Lynch doing right now? Well, he's on the 10th hole. He's even part of the front 9, but you know, he's in a trap right now. This could be a double bogey. This could be a quadruple bogey right here. Could blow the entire front 9 right here. You know, this is not what they wanted to hear. You know, so I have no idea when the market's going to go down, and no idea when it's going to go up. I'm totally shocked. The market was 4,000 2.5 years ago. A while ago, it's 8,000. I had no idea about this. Very surprising to me. But I'll guarantee you the market will be a lot higher in 15 years. It'll be a lot higher in 25 years. What it's going to do in the next 1 or 2 years, I don't have any idea. And if somebody in this room knows about it, they're not telling anybody. Or they're not in this room. They're down in Palm Springs somewhere. You know, they've made $1 billion. Or if they know anything about interest rates. Because in interest rates, if you can be right 5 times in a row in 10 grand, you can have $2 billion. It's not that many people with $2 billion. There's a lot of people predicting interest rates. Did you ever think about that one? Just 5 times right in a row in 10 grand, $2 billion. If you write 7 times in a row, you can have the GNP of, you know, the United Kingdom. You know, it's a big number. So I don't worry about that. I know we've had 96 years of century, and the market's fallen 53 times. We've had 53 declines of 10% or more. So 53 declines in 96 years. Once every 2 years, we have a 10% decline. Of the 53 declines, 15 have been 25% or more. So 15 in 96 years, about once every 6 years, the market falls 25% or more. That's what we call a bear market, you know that. And it's going to happen. I don't care when it's going to happen. I would love to know. Obviously, it would be very useful to know when it's going to happen. It doesn't make a difference to me. Corporate profits will be a lot higher 8 years from now, a lot higher 16 years from now, a lot higher 30 years from now. That's what I deal with. And I'll be glad to answer your questions. It's great. Enjoyed it. And I want to start the questions. If they don't get the question, I'll read the calendar of offerings for Friedman Billings for the next one. Okay. Do you like international stocks? The question is, I found I was better overseas than I was domestically because there's just less coverage. There's less people following these companies. So I think my big theory, and I think it's valid, if you look at 10 companies, you'll find one that's mispriced. If you look at 20, you'll find 2. If you look at 100, you'll find 10. The person that turns over the most rocks wins the game. Overseas, the numbers are much better. There's just not that much coverage. So I think international stocks are definitely worth looking at. When do you sell stocks? When you sell a stock is exactly the reason you buy it. You write down the reason you bought it. I bought Subaru. Subaru was a distributor. They didn't actually make the cars. I think it was Fuji Heavy Industries made the cars. They distributed Subarus in the United States. The stock was, I think the stock was 80. It was up from 6 to 80. I was a little late on this, but it didn't bother me, and I should never let that bother you. I didn't let it bother me. They had $40 a share in cash. They had a very low-priced car. It was well-liked. And it did well for about 5 or 6 years, and I think the stock went from 80 to 320. The reason I sold Subaru, thank you. The reason I sold Subaru is Hyundai came in with a low-cost car. Chrysler cut the price of the Omni Horizon. Ford came out with a low-priced car at the end. All of a sudden, the Subaru was no longer unique. If the car's not a buy, the stock's not a buy. That's what you're looking for. The reason you buy a stock, you keep it posted. If the reason changes, you go on to something else.
Are you concerned about the volatility in the financial markets today? Do you think something needs to be done to reduce it?
I love volatility. I remember when in 1972 the market went from down dramatically, and Taco Bell went from 14 to 1. They had no debt. They never had a restaurant close, and I started buying at 7, but I kept onto it, and it went to 1. And it was the largest position in Magellan in 1978 when it was bought out by $42 by Pepsi-Cola, and I think it would have gone to 400 if they didn't buy it out. I think volatility is terrific. I think these callers are very important. I don't think the market going up 80 points one day and down 80 the next is a good thing for the public. I think that's not a very good thing. But I think all of these callers and all these other things, to keep the volatility down each day is important. But the market's going to go up and down. Human nature hasn't changed a lot in 25,000 years. And some event will come out of left field, and the market will go down or the market will go up. So volatility will occur, the markets will continue to have these ups and downs. I think that's a great opportunity if people can understand what they own. If they don't understand what they own, they can own mutual funds, try to figure out mutual funds they own, and keep adding to it. Basically, corporate profits have grown about 8% a year, historically. So corporate profits double about every 9 years. The stock market ought to double about every 9 years. So I think the next market's about 3,800 today, 3,700. I'm pretty convinced the next 3,800 points will be up. It won't be down. The next 500 points, the next 600 points, I don't know which way they're going. So the market ought to double in the next 8 or 9 years. It ought to double again in the 8 or 9 years after that. Because profits will go up 8% a year, and stocks will follow. That's all there is to it. But you should study history, and history is the important thing you learn from. What you learn from history is the market goes down. It goes down a lot. The math is simple. There's been 93 years a century. This is easy to do. The market's had 50 declines of 10% or more. So 50 declines in 93 years. About once every 2 years, the market falls 10%. We call that a correction. That means that's a euphemism for losing a lot of money rapidly. But we call it a correction. And so 50 declines in 93 years, about once every 2 years, the market falls 10%. Of those 50 declines, 15 have been 25% or more. That's known as a bear market. We've had 15 declines in 93 years. So every 6 years, the market's going to have a 25% decline. That's all you need to know. You need to know the market's going to go down sometime. If you're not ready for that, you shouldn't own stocks. And it's good when it happens. If you like a stock at 14 and it goes to 6, that's great. You understand the company, you look at the balance sheet, and they're doing fine, and you're hoping to get to 22 with it. 14 to 22 is terrific. 6 to 22 is exceptional. So you take advantage of these declines. They're going to happen. No one knows when they're going to happen. It would be people tell you about it after the fact that they predicted it, but they predicted it 53 times. And so you can take advantage of the volatility in the market if you understand what you own. Excuse me. There's a lot of times people buy on the basis the stock has gone down this much. How much further can it go down? I remember when Polaroid went from 130 to 100, people said, here's this great company, great record. If it ever gets below 100, just buy every share, and it did get below 100. A lot of people bought on that basis saying, look, it's gone from 135 to 100. It's now 95, what a buy. Within a year, it was 18. And this is a company with no debt. I mean, this is a company, it was just so overpriced, it went down. I did the same thing in my, I think my first or second year at Fidelity. Kaiser Industries had gone from $26 a share to 16. I said, how much lower can it go? It's 16. So I think we bought one of the biggest blocks ever on the American Stock Exchange of Kaiser Industries at 14. I said, it's gone from 26 to 16. How much lower can it go? Well, at 10, I called my mother and said, Mom, you got to look at this Kaiser Industries. I mean, how much lower can it go? It's gone from 26 to 10. Well, it went to 6, it went to 5, it went to 4, it went to 3. And now unfortunately this happened rapidly, or I would probably be still caddying or be working at the Stop and Shop, but it happened fast. So I was able to, it was compressed. And at 3, I figured out, there's something very wrong here, because Kaiser Industries owns 40% of Kaiser Steel, they own 40% of Kaiser Aluminum, they own 32% of Kaiser Cement, they own Kaiser Broadcasting, they own Kaiser Sand and Gravel, Kaiser Engineers, they own Jeep, they own business after business, and they had no debt. Now, I learned this very early. This might be a breakthrough for some people. It's very hard to go bankrupt if you don't have any debt. It's tricky. Some people can approach that. It's a real achievement. But they had no debt, and the whole company at 3 was selling at about $75 million. At that point, it was equal to buying one Boeing 747. I said, there's something wrong with this company selling for $75 million. I was a little premature at 16, but I said, everything's fine, and eventually this will work out. And what they did is they gave away all their shares to their shareholders. They passed out shares in Kaiser Cement, they passed out shares in Kaiser Aluminum, they passed out their public shares in Kaiser Steel, they sold all the other businesses, and you get about $50 a share. But if you didn't understand the company, if you're just buying on the fact the stock had gone from 26 to 16, and then it went to 10, what would you do when it went to 9? What would you do when it went to 8? What would you do when it went to 7? This is the problem that people have, is they sell stocks because they didn't know why they bought it, then it went down, and they don't know what to do now. Do you flip a coin? Do you walk around the block? What do you do? Psychiatrists haven't worked so far. I've never seen them running in. The psychological psychiatry fund I've never seen listed for with the SEC to make it through as a mutual fund. So they haven't seemed to help. I've tried prayer. That hasn't worked. So if you don't understand the company, you have this problem when they go down. Eventually, they always come back. This one doesn't work either. People think RCA just about got back to its 1929 high when General Electric took it over. A lot of double knits never came back. Remember those beauties? Floppy disks, Western Union. The list goes on and on. People saying it'll come back. Well, it doesn't have to come back. Here's another one you hear all the time. It's $3. How much can I lose? I've had people call me up saying, I'm thinking of buying the stock at 3. How much can I lose? Well, again, you may need a piece of paper for this, but if you put if you put $20,000 in a stock at 50, or your neighbor put $20,000 at 50 into the stock, and you put $20,000 in at 3, and it goes to 0, you lose exactly the same amount of money, everything. And people say it's 3. How much can I lose? Well, if you put $1 million on it, you can lose $1 million. Just the fact that stock, this may be a reason to research a stock. The fact that stock is 3 down from 100 doesn't mean you should buy it. And in fact, short sellers, people that really make money in stocks, they don't short Walmart, they don't short Home Depot, they don't short the great companies, Johnson & Johnson. They short stocks down from 80 to 7. They'd like to short it at 16 or 22, but they figured out at 7 that this company is going to go to 0. They just haven't blown taps on this thing yet. It's going to 0. And they're selling it short at 7, they're selling it short at 6, at 5, at 4, at 3, at 2, at 1 1/4. And you know to sell something short, you need a buyer. Somebody has to buy the damn thing. And you wonder, who's buying this thing? It's these people saying it's 3. How much lower can it go?
When you were actively managing money, you presumably were under the same pressures as other fund managers to show performance results. Right. Did that incline you to sell too quickly sometimes?
Well, I think my greatest mistakes are, it's funny, on a stock, all you can lose is 100%. I've done that. But your great mistakes is selling a good company, and then it doubles, then it triples and quadruples, because you make a lot of mistakes, and so those ones that go up tenfold, I call them the 10 baggers. So some of my mistakes are just saying, oh my God, this stock is too high, and I was wrong. And you had to figure out, what inning am I in this baseball game? I sold Toys R Us way too early. It went up 20-fold after I sold. I did the same thing at Home Depot. Those are probably my 2 greatest mistakes I ever made.
When should you sell?
Well, you ought to find out why you bought a stock. If you're saying it's a cyclical company and they're doing poorly, and they're doing awful, you wait till things are getting better, and they're doing terrific, and then you sell it. But with a growth company, you have to say, Walmart's case, 10 years after they went public, you could have bought the stock and made 500 times your money. Because they still are only in 15% of the United States. And they could say, why can't they go to 17? Why can't they go to 19? Why can't they go to 23? So for the next 4 decades, they went around the country. So you have to say to yourself, in this stock, I have a 10-year story, a 20-year story. You ought to be able to write that down and follow that. That's what I do with the company. And that's your decision. That's how you sell it.
We have a novel element for many investors today in the trust issue.
Yes.
We also have security problems that we didn't traditionally have in America. have they changed the way you pick and believe in stocks?
No, you still buy a company, and you buy a company to grow. And if it's a textile company or it's an electronics company or a software company, you better understand what they do. And if they do well, the stock will do well, no matter what happens to the market. If the Dow Jones today was 1,000 or 500, you would have made a lot of money in McDonald's. You would have made a lot of money in Johnson & Johnson. You would have made a lot of money in Gillette. These companies' earnings have gone up a lot the last 30 years. And if the market was 50,000, you would have lost money in Burlington Industries. I recommended that in 1969. I think it's gone from 34 to 2 with no stock splits because their earnings have been terrible.
Well, your modesty actually makes an important point, which is people with the best batting averages in the world don't bat 1,000. I sometimes get angry mail, particularly during bear markets, saying so-and-so recommended such and such and it went down.
Yeah.
Well, how often did you come up with a clinker?
Well, this is a funny business. You don't have to be right even 5 times out of 10. If the times you're right, you make a double and triple. It offsets all those times you lose 20 or 30%. So when you buy a stock, you got to say to yourself, how much can I lose and how much can I make? And you ought to be able to make a lot. Because stocks are risky. I mean, look at how much we lost on AT&T. Look how much we lost in Xerox. These were quality companies. You know, you can lose a lot in a stock. So you got to say to yourself, how much can I make? Because I want to buy a stock, if I'm right, I'm going to make a double or triple.
Does your own confidence ever get shaken?
Every day I think the market's going to go up. You know, I keep calling a lot in my company, so I keep calling the company.
October has always been a special month. I remember in 1987, I was very, I was very convinced the market was, not in trouble, and I didn't worry about things. And Carol and I had planned this great golf vacation to Ireland, and we're going to visit one course and stay at a little house and visit another, go all along the west coast of Ireland and play golf. And we left on a Thursday night, and the market went down 55 points that day, which was not too good. And the next day we got to Ireland, because of the time difference, we'd completed our day, and I got back to the hotel and I called in. The market had gone down 112 on Friday. I said to Carolyn, I think if the market goes down on Monday, we're going to have to go back. And so we stayed there for the weekend. And on Monday, the market went down 508 points, and my fund went from, I think, 12 billion to 8 billion. And that gets your attention, in two working days. I said at the end of this week, I'd be have no fund. Now, there wasn't a lot I could do. I mean, here I was on Monday, because the market didn't open, by 12 o'clock it was, in Ireland, it was still 7 o'clock in New York. So we did spend that day, and we played around golf in the morning, and then we went somewhere and sort of watched the market deteriorate. And I did come back. There wasn't nothing I could do. I mean, just nothing I could do about it. But I think my shareholders, they called up and they said, well, what's Lynch doing? They said, well, he's on the 6th hole, and he's, he's even par up to now, but he's in a trap. This could be, this could be a triple bogey here. This could be a big inning. And I don't think that's exactly what they want to hear. So I could do something about this damn thing. So I came back home and suffered with everybody else. And fortunately, I was very consistent. The market went down when I ran Magellan. On 13 years, the market went down 9 times, and every time the market went down, Magellan went down. I was 9 for 9, and because it's very important. This is another one of these numbers you ought to write down. If you put $1,000 in a stock, all you can lose is 1,000. I've done that several times, and but if you're right, you can make 5,000, 10,000, 20,000. So this business, you don't have to be right 1 out of 2 times. You can be right 1 out of 4. It's a long time. The times you're right, you know the company's doing well, you know they're doing a great job, and you add to it, or at least you don't sell it, which is a terrible tragedy. So you can make more money on the upside. So I just wrote those out, and I will now flip a coin to tell you where the market will go to 4,000 this year or next year. Heads means it goes up. It's a 2-headed coin. The market will go up in the next year. That's it.